Hey guys, welcome back to my channel. In today's video, I want to talk more about candlesticks for beginners and how to use these candlesticks in your trading. So before I continue, this is the last video before Christmas, so I'd like to take this chance to wish you guys a Merry Christmas and a Happy New Year. Ho ho ho! Okay, I don't know why I'm doing that. That's really weird. But alright, let's get back to the candlestick patterns. When I first got started in investing and trading, I would look at the candlestick chart and I would be lost. I didn't know what to look out for, and all I could see at the time was just red and green candlesticks on my candlestick chart. So over time, as I learn more and look at the charts more often, I start to realize that there were a lot of information that you can get and use in your investing and trading just by looking at these candlesticks and the candlestick patterns. So in this video, I'll be going through the different candlesticks and candlestick patterns, explaining what they mean with real-life examples, the psychology behind them, and perhaps more importantly, how you can use these candlesticks in your trading. So it will be value-packed, so make sure you stick around in this video so you won't miss anything. With that, let's dive right in. I'm on my screen now, so let's get started. So what a candlestick shows us is the movement of the stock price for that particular time frame. So the time frame can be anything from 5 minutes, 30 minutes, 1 hour, 1 day, 1 week, and so on. So what candlestick time frame is used depends on the individual investor and trader and their investing and trading goals. So if you are an intraday trader, then you might use the 5 minutes and 30 minutes candlesticks. But if you are a medium-term or long-term investor and trader, then you're more likely to use the 1 day and 1 week candlestick. So in this presentation, I'll be using the daily candlestick. So one candlestick would represent prices for one trading day. So before we start looking at candlestick patterns and the candlestick charts, we first need to take a look at the individual candlestick and what makes a candlestick and the elements in it. So this is how a candlestick looks like. We have the body of the candlestick, which is the rectangular part of the image, and the wicks, which are the lines sticking out of the body. So the rectangular part of the candlestick is called the body, and the lines that stick out of the top of the body is called the upper wick, and the line sticking out of the bottom of the body is called the lower wick. So the tip of the upper wick represents the highest price that the stock reached for that day, and the tip of the lower wick represents the lowest price that the stock reached for that day. So the next thing we need to know about a candlestick is whether the candlestick is a bullish or bearish candlestick. So a bullish candlestick means that prices move up that day, and a bearish candlestick means that prices fell for that day. So there are two main types of candlesticks on your candlestick chart: the bullish and the bearish candlestick. So a bullish candlestick is indicated by a green candlestick, and a bearish candlestick is indicated by a red candlestick. So some investors and traders may use different colors, but green and red are by far the most commonly used colors, and that is what I also personally use. We learned earlier on that the tip of the upper wick indicates to us the day's highest price, and the tip of the lower wick indicates to us the day's lowest price. So the body of the candlestick also tells us the opening and closing price for the day. So for a bullish candlestick, the opening price is at the lower part of the body, and the closing price is at the upper part of the body. So why is this so? Remember that a bullish candlestick means that prices rose for the day. So when prices rise, the closing price for the day is higher than the opening price. So that is why for a bullish candlestick, the opening price is lower than the closing price. For a bearish candlestick, the opposite is true. So we know that a bearish candlestick means that prices fell for the day. So when prices fall, the closing price for the day is lower than the opening price. Therefore, the opening price is higher than the closing price for a bearish candlestick. Okay, let's do a quick recap of what we have ran through so far. We learned that there are two main types of candlesticks. The first is the bullish, and then the second is the bearish candlestick. So a bullish candlestick is green in color, and a bullish candlestick indicates that prices rose for the day. So for a bullish candlestick, the opening price is at the lower part of the body of the candlestick, and the closing price is at the upper part of the body of the candlestick. And the tip of the upper wick represents the day's highest price, and the tip of the lower wick represents the day's lowest price. So for the bearish candlestick, it is red in color, and it indicates that the prices fell for the day. So as such, for bearish candlestick, the closing price is at the lower part of the body and lower than the opening price, which is at the upper part of the body. So similarly, the tip of the upper wick represents the day's highest price, and the tip of the lower wick represents the day's lowest price. Okay, so now that we have ran through the elements that make up a candlestick, let's understand a bit of the psychology behind the bullish and bearish candlestick. So when the price closed at a higher price than the open, we say that investors and traders are bullish for the day. So why is this so? So if we take a look at the candlestick, let's say the stock opened at $10. If there are more investors and traders who want to buy the stock than there are investors and traders selling, what will happen? Prices will rise, right? When there are more buyers than sellers, prices will rise. So prices will continue to rise, and at one point, prices will reach all the way to the day's highest price, say at $13. So at the day's highest price, what happens? Investors and traders seeing that the price is $13 and that the stock is getting a bit expensive will stop buying the stock. And what about the sellers? When prices are at $13, sellers are looking to sell their stock to make some profits. So at the day's highest price, there will be more sellers than buyers, and prices will fall. So sellers will push the stock price down. But this will not go on forever, because the market is only open for certain hours of the day. So for example, if you are trading in the US stock market, in the New York Stock Exchange, then the market's open only from 9:30 a.m. to 4 p.m. So sellers will try to sell their stock and push prices down. But this battle between like the buyers and the sellers will end when the market closes. So say that the sellers managed to bring prices back down from the day's highs of $13 to $12. So this means that prices close at $12 for the day. So remember that the day's opening price is $10. So since prices rose from $10 to $12, buyers won the sellers and managed to push prices up. And we say that the day and the stock is bullish. And it is very similar for bearish candlestick. So for a bearish candlestick, let's say that prices open at $100. Maybe at the start, buyers were more excited and they will manage to push prices up to $102. But once at $102, the sellers start to take control and started to sell their stock. So these sellers will push prices all the way down to say $95. However, at $95, some buyers might feel at that price the stock is a bargain and they will start buying. So buyers start buying up the stock and push the price all the way up. But before they push prices any further, the market closed and they only managed to push it up to $97. So $97 will then be the closing price of the stock. So with all this information, how will the candlestick look like for the day? So to draw a candlestick, we need to know 4 things. So the opening price, the closing price, the day's high price, and the day's low price. So we know that the opening price is $100 and is higher than the closing price, which is $97. So the candlestick will be bearish and red in color. So the opening price goes up to the upper part of the candlestick body, and the closing price goes to the lower part of the candlestick body. So what's the next thing to put in? Correct. The next thing we put in are the wicks. So we mentioned earlier that the day's highest price is $102. So then we draw a line from the upper part of the body of the candlestick to reach to the day's highest price. That will give us the upper wick. So we do the same thing for the lower wick by first indicating the day's lowest price, which is $95. And then drawing a line from the lower part of the body to that point, and this gives us the lower wick of the candlestick. And that is it. That's how we get a candlestick. So those are the elements behind a candlestick and a bit of the psychology behind it. So now let's take a look at some of the variations of the candlestick. So this is a Doji candlestick. So a Doji candlestick is a candlestick with small or negligible body. So an example of a Doji candlestick is the one that you can see on the screen right now. So all the elements in a standard candlestick can be still found in the Doji candlestick. So we have the opening and closing price and the day's high and lowest price. So the only difference or variation is that the Doji candlestick has a smaller body. So far, we've learned that investors and traders are either bullish or bearish. So the Doji candlestick, however, indicates that investors and traders are undecided. So there is almost an equal number of bullish investors and traders. So a Doji candlestick means that investors and traders are neither bullish nor bearish. So why is this so? As always, we can always go back to the candlestick to gain a deeper insight into the psychology and emotions behind investors and traders. So let's say that the opening price is at $11. So prices open at $11, and when prices open at 11, prices drop to the lowest point at $7. But my buyers had managed to push prices all the way up back to $13. However, at the highest price, $13, sellers push the price all the way back down to, let's say, $11.20 and closes at the price level. So even though the buyers managed to push prices all the way up to $13, the sellers were strong enough to push prices all the way back to the close to the opening price at $11.20. So what this tells us is that while buyers felt that prices should rise, there were an equal number of sellers who think that prices shouldn't. So buyers and sellers cancel one another out, and the closing price is very close to the opening price. Therefore, the body of the Doji candlestick is very small and negligible. And then the Doji candlestick also represents the indecision in the market. So what does it mean when a Doji candlestick appears in our candlestick chart? So if a Doji candlestick appears, it usually means that the existing trend might be reversing. Check out my video on technical analysis for beginners where I go more in depth about the different types of trends and how to determine a trend. So if a Doji candlestick appears in an uptrend, this can indicate that the uptrend might be reversing into a downtrend. And if a Doji candlestick appears in a downtrend, this can indicate that the downtrend might be reversing into an uptrend. So the Doji candlestick is the first variation of the candlestick, and it indicates to us that the existing trend might be reversing on your charts. So there's no certainty in investing and trading. So it doesn't mean that the appearance of a Doji candlestick means that the trend is 100% certain that it's going to reverse. It just means that the trend tends to reverse more often than not when a Doji candlestick appears. So again, this applies to all other candlesticks and candlestick patterns that we'll be taking a look during this presentation. So they do not indicate 100% certainty that prices are going to move in a certain direction. What these candlesticks and candlestick patterns help us investors and traders is to give us a greater probability of success in the markets by providing us these signals and signs. So with that said, let's take a look at the other candlestick and patterns and how they can help us. So the second variation that we'll take a look at is the bullish pin bar. So this is how a bullish pin bar looks like: a small body with a long lower wick. So the opening price is at the lower part of the body and the closing price is at the upper part of the body. So the bullish pin bar doesn't have an upper wick, only a lower wick. So when a bullish pin bar appears, especially when the stock or market is on a downtrend, it indicates that a bullish reversal is likely to happen. So what does this mean? This means that the downtrend might be ending and reversing into an uptrend. To understand why the bullish pin bar is a bullish reversal signal, we need to understand the psychology behind the candlestick. So we know that the opening price is at the lower part of the body. So sellers push the price all the way to the lowest tip of the wick. So that is the day's lowest price. However, the buyers managed to push the price all the way back up beyond the opening price and close at a price higher than the opening price. So that is the closing price. So when a bullish pin bar appears on a downtrend, especially when prices have been on a downtrend for a while, this can indicate a bullish reversal because the bullish pin bar tells us that buyers managed to fight back against the sellers and win by pushing prices all the way back up. So this can be a turning point where the buyers start taking over control of prices from the sellers and start pushing the stock price up. Therefore, a bullish pin bar indicates to us a possible bullish reversal and is best used when it appears after prices have been on a downtrend for a period of time. The third variation is the bearish pin bar. So the bearish pin bar is the opposite of the bullish pin bar and it indicates a bearish reversal. So the bearish pin bar is best used when it appears after prices have been on an uptrend for a while. So it indicates that prices might start reversing into a downtrend soon. So the psychology behind the bearish pin bar is that prices open at the upper part of the body of the candlestick and the buyers with the uptrend and bullish momentum behind them push the price up. However, the sellers start to take control and push prices all the way back down and below the opening price to close at a price lower than the opening price. So this shows us at this point in time, sellers manage to wrest back control from the buyers to push prices back down. So this can be an indication that the uptrend is losing momentum and might start reversing. So we have taken a look at the bullish and bearish candlestick and the different variations of the candlestick, namely the Doji candlestick, the bullish and bearish pin bar. So let's look at some real life examples of these candlesticks and see whether you are able to identify and spot these candlesticks. Okay, so this is an example of a candlestick chart. So in this chart, can you identify where the bullish pin bar is? Okay, so as you can see, the bullish pin bar is indicated by the arrow pointing to it. So this is the bullish pin bar. So remember, a bullish pin bar is a candlestick with a small body and a long lower wick. So this is the bullish pin bar. And what does the bullish pin bar tell us? So a bullish pin bar tells us that a bullish reversal signal might be, or a bullish reversal might be happening soon. So can you see that before the bullish pin bar appears on the screen, the previous trading days or previous 4 trading days were bearish. So there's 1, 2, 3, and 4. So there were, before the bullish pin bar appears, there were 4 bearish trading days before. And then what happened after the bullish pin bar appears? Correct. So what happens after the bullish pin bar appears is that prices start to rise. So that is what a bullish pin bar can indicate to us, a possible bullish reversal. Okay, let's take a look at another example. So in this case, or in this price chart, can you identify where the bearish pin bar is? Take a couple of moments and pause the video to identify where the bearish pin bar is. Alright, so the bearish pin bar is here. As you can see, this small bearish candlestick. So remember again, a bearish pin bar is a candlestick with a small body with a long upper wick. So that is the bearish pin bar. So as you can see that before the bearish pin bar appears, prices were rising over time. And notice that once the bearish pin bar appears, what happened to prices? Correct. So prices after that start to fall gradually. So a bearish pin bar, what does it do for us? It indicates that a bearish reversal is on the way. So let's take a look at another example. So for this example, can you identify where the bullish pin bar is? Okay, so the bullish pin bar is indicated by the arrow. Again, the bullish pin bar, we can see that it has a small body and a long lower wick. So there's the bullish pin bar. So what happened? You can see that prices rose for a while and then it starts to gradually decline. And when you see when it starts to gradually decline and suddenly a bullish pin bar appears, what happened to prices? Prices start to, instead of falling or declining, we see that prices start to rise for a period of time. So that is a bullish pin bar. It indicates to us a possible bullish reversal from a downtrend. Okay, so now that we have understood the different one candlestick variations, let's take a look at the two candlestick patterns and three candlestick patterns. So the first two candlestick pattern that we will look at is the bullish engulfing pattern. So the first candlestick in the bullish engulfing pattern is a bearish candlestick and it is red in color. It is followed by a bullish candlestick and green in color. So that is the first criteria of a bullish engulfing pattern, that the first candlestick must be a bearish candlestick and the second candlestick must be a bullish candlestick. The second criteria is that the body of the bullish candlestick, the green color candlestick, must be larger than the body of the bearish candlestick and it must be engulfing it. So that is why we call it the bullish engulfing pattern. So the bullish engulfing pattern is a bullish reversal pattern. So again, what does a bullish reversal pattern means? It means that when this pattern forms after a downtrend or during a downtrend, especially if the downtrend has been ongoing for a while, the bullish engulfing pattern can indicate to the trader that the decline is ending and a reversal is about to take place. So let's take a look at a chart. Okay, so can you identify the bullish engulfing pattern in this chart? Take a few moments to identify where the bullish engulfing pattern is. Okay, you found it? Alright. Okay, so the bullish engulfing pattern is here, as indicated by the arrow. So remember what the two criteria for a bullish engulfing pattern? The first is that the first candlestick must be bearish and the second candlestick must be bullish. So it meets the criteria. So what is the second criteria? The second criteria is that the body of the bullish candlestick must be larger and engulfing the bearish candlestick. So in this case, the bullish candlestick is larger than the body of the bearish candlestick and is engulfing it. So it fulfills the two criteria. So that is the bullish engulfing pattern. So what does a bullish engulfing pattern means? It means a bullish reversal is happening, might happen, and it gives us a very high probability that a bullish reversal is happening. So as you can see, before the bullish engulfing pattern appeared, can you see that prices were bearish for the 3 previous trading days? So prices were falling 3 days in a row. And once the bullish engulfing pattern appeared, what happened to prices? Prices start to make its rise and continue to advance, correct? So that is what a bullish engulfing pattern means for us. It can indicate a possible bullish reversal signal. So a bullish reversal signal means that when prices start to decline and when suddenly a bullish engulfing pattern appeared, it means that prices are likely or have a higher probability of advancing rather than declining. So that is the bullish engulfing pattern. So the next pattern is the bearish engulfing pattern. So the bearish engulfing pattern has also two criteria. The first is that the first candlestick must be a bullish candlestick and the second a bearish candlestick. So that's the first criteria. The second criteria is that the body of the bearish candlestick is larger than the body of the bullish candlestick and must be engulfing it. So that is the bearish engulfing pattern. So the bearish engulfing pattern indicates to us a bearish reversal pattern. So what this means is that when you see the bearish engulfing pattern appearing in your price chart when it's on an uptrend, especially if the uptrend has been going on for a while, this can indicate that the uptrend is losing momentum and might be reversing into a downtrend. So let's take a look at the charts to see a real life example and how this bearish engulfing pattern can give us the right signals. Okay, so on this price chart, can you take a moment to identify where the bearish engulfing pattern is? Okay, so the bearish engulfing pattern is indicated by this arrow. So remember the two criteria. The first is that the first candlestick must be a bullish candlestick and then the second candlestick must be a bearish candlestick. So that's the first criteria. And the second criteria is that the body of the bearish candlestick must be larger than the body of the bullish candlestick. So as you can see, it fulfills the two criteria. So this is a bearish engulfing pattern. So notice that before the bearish engulfing pattern appeared, what happened? There were how many days of prices rising and were bullish. So 1, 2, 3, 4, 5. So there were 5 consecutive trading days where prices were bullish. And then what happened? When the bearish engulfing pattern appeared, take a look at what happened to prices. Prices start to decline instead of rise. So again, when the bearish engulfing pattern appears, it indicates to us that a bearish reversal pattern might be appearing. So if it's on an uptrend, this bearish engulfing pattern indicates to us that prices are likely to decline instead of continue to rise. So that is what a bearish engulfing pattern means. So those are the 2 candlestick patterns. So now let's take a look at the 3 candlestick patterns. So the first 3 candlestick patterns is the 3 white soldier pattern. So this pattern consists of 3 consecutive bullish candlesticks with each candlestick closing higher than the previous day, and that each day's opening price opens within the body of the previous day's candlestick. So when the candlestick appear like this is the 3 white soldier pattern. So the 3 white soldier pattern is a very bullish signal. So when the 3 white soldier pattern appears in a downtrend, this suggests that the buyers have managed to take control of not 1, but 3 consecutive days of trading. So with such bullish momentum, this can indicate that the downtrend and the decline is about to reverse. Okay, so on this price chart, can you identify where the 3 white soldier pattern is? Alright, so the 3 white soldier pattern is here, indicated by the arrow. So as you can see, there were 3 consecutive bullish candlesticks, and then that each candlestick opens within the previous day's candlestick. So that is the 3 white soldier pattern. So as you can see that when the 3 white soldier pattern appeared, what happened after to prices? Prices continue to rise over time. So that is what a bullish or 3 white soldier pattern can indicate to us. It indicates to us a very bullish momentum of prices. So the next candlestick pattern is the 3 black crows pattern. So the 3 black crows pattern is the opposite of the 3 white soldier pattern. So it has 3 consecutive bearish candlesticks, each closing lower than the previous day, and with each day open occurring within the body of the previous day's candlestick. So when you see the 3 black crow patterns forming when prices are on an uptrend, you should be warned and start taking some profits, if not all of your profits, because this is because sellers have taken control of 3 consecutive days of trading. So further decline in prices is likely to happen. So on this price chart, can you identify where is the 3 black crow pattern? Okay, as you can see, it's here. So as indicated by the arrow. So you can see that there are 3 consecutive bearish candlesticks, and that each open occurs within the previous day's body and the previous day's candlestick. So that's the 3 black crow pattern. So what does the 3 black crow pattern indicate to us? It indicates that prices are experiencing a very bearish momentum and that prices are likely to fall over time. So the 3 black crow pattern indicate to us that prices are experiencing very bearish momentum. So as you can see that immediately after the 3 black crow patterns appeared, prices start to decline. So that is the 3 black crow pattern. So the next pattern we'll look at is the morning star pattern. So the morning star pattern is also a 3 candlestick pattern. So this is how a morning star pattern looks like. The first candlestick of the pattern is a bearish candle, and then followed by a doji candlestick, and the last is a bullish candlestick. So that's the first thing to look out for. The next thing to look out for is that there must be a gap between the bodies of the bearish candlestick and the doji candlestick, and also a gap between the bullish candlestick and the doji candlestick. So on your screen, you can see that there's a gap between the closing price of the bearish candlestick and the body of the doji candlestick, and there is a gap between the opening price of the bullish candlestick and the body of the doji candlestick. So once these two things are in place, we can say that the candlestick form a morning star pattern. So in a downtrend, when we see the morning star pattern form, we want to take note, because the morning star pattern can indicate to us a possible reversal of trend from a downtrend to an uptrend. So as always, the psychology of the candlestick can explain to us why a morning star pattern indicates a bullish reversal pattern. So the first candlestick is a bearish one, and it doesn't really hold much significance in this context. The second candlestick, however, is a Doji candlestick. So we learned earlier that because the buyers match the sellers, the Doji candlestick indicates indecision in the market. So there's no clear direction where the stock is moving. So the Doji candlestick gives us the first warning that the decline and downtrend might be losing momentum because buyers and sellers are indecisive. Then the third candlestick after the Doji candlestick is a bullish one. So after the indecision from the previous day, from the Doji candlestick, buyers managed to win the sellers and push prices up. So this gives us further indication that the downtrend might indeed be reversing into an uptrend or losing its downward momentum. So that is why the morning star pattern is a bullish reversal pattern, and if you see it form, ideally after prices have been on a downtrend for a while, and if the Doji candlestick forms just above a support level, the morning star pattern can be a very powerful bullish reversal pattern for investors and traders. Okay, so on this chart, can you see where the morning star pattern forming? Okay, so the morning star pattern, as you can see, is indicated here. The first is the bearish candlestick, followed by a Doji candlestick, followed by a bullish candlestick. That's the first criteria. The second criteria is that there must be a gap between the body of the bearish candlestick and the body of the Doji candlestick, and there must be a gap between the body of the bullish candlestick and the body of the Doji candlestick. So once those two criteria are in place, we say that that is an morning star pattern. So on the charts, you can see that before the morning star pattern form, can you see what prices are generally on a decline? Because prices have been falling. So once the morning star pattern appeared, what happened to prices? Prices start to advance and move up. So why is this so? Remember, we said that the morning star pattern can indicate to us a possible bullish reversal. So as you can see that once prices were declining, and when the bullish reversal pattern appeared, which is the morning star pattern, what happened? Prices start to, instead of continue to decline, it starts to advance. So that is what a morning star pattern can indicate for us on our charts. So the next pattern is the evening star pattern. So the evening star pattern, like the morning star pattern, is a 3 candlestick pattern. So this is how the evening star pattern looks like on the chart. So the first candlestick is a bullish candlestick, followed by a Doji candlestick, and lastly a bearish candlestick. So the evening star pattern is a bearish reversal pattern when it appears on an uptrend. So the first bullish candlestick again does not tell us of anything significant. The next Doji candlestick, however, tells us that there's indecision in the market about prices. So buyers are no longer taking control of prices for the day. Instead, the sellers manage to match the buyer's strike for strike. So the next day, a bearish candlestick appears, and this means that sellers manage to take over control of prices from buyers and push prices down. So the indecision followed by a bearish candlestick can indicate to us that the uptrend is losing momentum and might be reversing soon. And that is why the evening star pattern is a bearish reversal pattern. It is important to know when to use these candlesticks. So candlestick patterns should not be used in isolation, but rather as a complement to other indicators such as the moving averages, the support and resistance level, Bollinger Bands, and so on. So what do I mean by that? We learned that a bullish pin bar, as its name suggests, is bullish in nature and is a bullish reversal pattern. But we don't buy just because a bullish pin bar appears. We buy only when the bullish pin bar appears with other indicators, for example, on a downtrend, and that the downtrend has been going on for a while, and when the bullish pin bar appears at a support level. So if a bullish pin bar appears when prices have been on a decline for a while, there is greater probability that prices might reverse. So that is check 1. The next thing is when the bullish pin bar forms at or close to a support level. So we know that prices have a tendency to bounce and rise at a support level or near the support level. So when a bullish pin bar appears at a support level, there is a greater probability that prices will bounce back up and reverse. So that's check 2. So when you have these additional things in place that supports a bullish reversal on top of the bullish pin bar, which by its nature is already a bullish reversal pattern, this gives us investors and traders greater probability of success in the markets. So while we can never be 100% certain in the market, we want our probability to be as high as possible. And by having all these patterns and conditions in place, we can increase our probability of success. Those are some of the candlestick patterns that I found to be useful in my investing and trading. So in this presentation, you have learned the psychology and meaning behind these candlestick patterns and how you can use them. So use these candlestick patterns along with the other indicators to maximize your chances of success in the markets. If you have liked this video, make sure you give us a thumbs up and subscribe to my channel if you want to learn more about the other indicators. I'll see you soon to your financial success.